Hello, everyone, and welcome to the Developing a Strong Bookkeeping Practice workshop that is offered through the Tallahassee Farmers Promotion Program through the Frenchtown Neighborhood Improvement Association. I just want to thank everyone for being here tonight, and thank you for flexibility for those that do come in person, and this being a virtual only option. So I'm Christina Lynch. So welcome back for those who have attended a workshop, and welcome to those who's attending for the first time. My background is accounting, finance, and HR management. So I have about 14 years of experience in accounting and HR, with 9 being in consulting for small businesses and entrepreneurs. I am the accounting and HR expert for the Small Business Development Center, the Business Empowerment Director for the Capital City Chamber of Commerce, and also the CEO for Trident Consulting. So I am here today to provide some humble knowledge on accounting and bookkeeping, and we'll keep it pretty much on the principle side. So we're not going to get into journal entries or debits and credits today, but the idea is to simplify the information and make it more digestible to gain buy-in and commitment to actually the practice and art of bookkeeping. If you have any questions throughout the workshop, feel free to raise your hand, unmute yourself, or put it in the chat. So whatever you're most comfortable with, since we are a smaller group, and that way I can answer the questions. This workshop is recorded. That way we can also add it to our YouTube page for future reference for you and for anyone else who may be missing the workshop tonight. So with that being said, if you have any questions, once again, feel free to interrupt. Otherwise, we'll get started. And I don't like to, when it comes to accounting, I try not to provide too much information at one time. As interesting of a process as it is, it's a lot of information to digest. So we try to provide it in sections. Hence why we'll have the year-long worth of workshops dealing with accounting, finance, and banking. So there is a difference and distinction between accounting and bookkeeping. So accounting is more of like your larger, broader categorization of financial documentation. So when we think about bookkeeping, we're thinking day-to-day. When we think of accounting, that's really when we're creating the reports that we use for analysis. So that includes just database management, invoice processing, the tax processing, payroll. And when you go to the bank and ask for documents, they're asking for those accounting documents, the profit and loss, and the balance sheet. The bookkeeping is your day-to-day techniques for your general record keeping. So theoretically, the bookkeeping is the foundation to having the accounting reports and to be able to manage the accounting. So today we're focusing on bookkeeping and how you as a prospective or current entrepreneur can use bookkeeping to help remain organized and also on task with the performance of your business. So we're focusing on how we're going to input the amounts, dates, and sources per item for both revenue and expenses. And then we'll touch a little bit on the analysis. Towards the end of the presentation, we will review the financial statements, just so that way we can see all of the hard work we're working on and what is the end result of that work. So financial management is bookkeeping and taxes together. So a couple weeks ago, we had our workshop on tax, the strategies for maximizing tax deductions and looking at what deductions are available for farmers and entrepreneurs and small businesses as a whole. With that, I mentioned that we can't do tax planning for a period that has already passed. Meaning, if you're waiting until tax season to determine how to lower your taxes for the prior year, well, that period has passed. So bookkeeping helps us in categorizing the information and really tracking our movement, tracking our operations throughout the year. And we use that information to assist with the tax planning process. So we want to identify the transactions in your business and the need to manage those finances. So when you're in business, there's things and resources that you're using that you may take for granted in wanting to document. For instance, your cell phone bill, that's a big one where We forget to document, okay, well, hey, I have this cell phone that I'm using for the business. I have the internet access for the business. So when we're looking at just the movement of the business, we're not only documenting the direct input expenses like the products or the raw materials to make your products to sell, we want to consider everything that's required for us to operate that business. We then want to be able to invest time and energy to document finances and understand them at a higher level. So part of our financial management process is investing that time and energy to make sure that we're creating quality reports, because if otherwise we'll have garbage in, garbage out. So in order for us to have accurate and reliable finances and financial reporting, we have to make sure we're putting in the proper amount of time to be able to document it on the front end. And then lastly, we want to be able to utilize that information to grow your knowledge and leverage your position. Many times when we're speaking about our goals and strategies, we want to consider where we are. So it's hard for us to attain our goals if we're not aware of what has happened in the past and where we currently are. And in business, that is critical, because if we know we want to grow, we want to be able to project our revenue, but we also want to project our expenses. And the best way to project is to know what are our current expenses, and then using that as a baseline to see which ones would increase and which ones would remain the same. So when we're thinking about bookkeeping, the first piece is organization. So think of it as I'm organizing all that has occurred and all of the transactions that have occurred in the business. So we're entering details into our ledgers, whether that's an Excel spreadsheet, if it's pen and paper, if it's QuickBooks, or Quicken, there's HoneyBook. So you have many options out here. But the idea is that we're just organizing those transactions. And then from there, we're going to tally the figures and summarize the details. But it first begins with organizing where are these transactions located and then centralizing them into one place. We then want to periodically balance the books, which is really ascertaining what has been spent and received. As great as banks are, we don't want to fully rely on them to ensure that every transaction that runs through the bank account is yours. So the purpose in balancing the books or reconciling is to validate, one, that all the transactions that you have are your transactions and that it matches your records. So there are times when I've seen where the bank may debit an amount larger than the actual transaction because the software didn't catch it and then their quality assurance person didn't catch it. So that's still on your responsibility to do as a business owner. And with businesses, some banks only give you 24 hours to actually communicate that, hey, this expense isn't mine. So being very diligent about validating your transactions is important. And then also being able to know what is owed and what is owned. So looking at what liabilities that you may have and tracking those liabilities and making sure that you know the progress of looking at the work that you're doing. Every payment means that's one less payment left. And it also helps in improving cash flow over time. But then knowing what money is due to you and ensuring that you're tracking your receivables and getting paid on time, or addressing when you see vulnerabilities from customers who aren't paying in the time frame in which they're supposed to. And then knowing if your company is making money or losing money. I can't tell you how many times money's coming in, everything is great, but then as your business is growing, there is a point where you may be spending more than you're earning. And if you don't have the proper bookkeeping, it's very easy to focus on the cash flow coming in and thinking and assessing the business based off of what's coming in and then getting stuck. So I hear there occasionally I'll hear, hey, I make all this money, but it seems that there's never money in my bank account. And because you're looking at the cash flow, but we're not sitting down and looking at the financials and determining what is the true performance of the business. So the funny thing about accounting is that your profit and loss may say you made money, but your bank account and the cash flow is negative. So what does that mean? So being able to look at the performance of the business, validating those transactions, and ensuring that we're using that information to strategize on how to strengthen and grow your business is important. And then also setting up and maintaining inventory systems. So if you're one that has a physical product or produce, how are you tracking your inventory and turnover, making sure that you're turning over fast enough to where you're selling goods while they're good and you're not incurring a huge loss. And then knowing at what point do we need to push the sale. We see it in retail or department stores at a certain time in the season. We see where the thing that you were waiting on to go on sale goes on sale, right? They're trying to push that out because the new season's coming up. So now we're in the heart of spring. Come around end of May, June, we'll see where all the spring clothes goes on sale as they're trying to now promote the summer clothes, right? So looking at maintaining a system where you can identify what you have and at what point do you may need to address either pushing inventory out, reducing your price, or also seeing what other avenues are available to be able to sell. Are there any comments, questions, or concerns up until this point? Okay. So with organization, we want to record and classify our transactions. So once we organize them and we're able to put them in one place, that's when we classify them, and ideally utilizing categories that will allow for us to classify consistently. So if you have your cell phone bill, making sure that we always put that to telephone bill or telephone expenses. Occasionally, we'll see where even relying on QuickBooks or a system, it will accidentally begin categorizing a transaction to the wrong account, and which that can lead to having misstated financial statements. And so there's times when that expense ends up on the balance sheet, so it looks like you've made more money than you actually did. Or we have asset items showing up on your profit and loss, where it looks like you're doing worse than you actually are. So not only are we organizing the transactions and putting them in one place, we want to be able to consistently categorize them in a flow that makes sense and is a best reflection of your business. If you're using a personal account for your business, I highly advise having a business account. The other thing that I see a lot is having business expenses coming out of the personal account or personal expenses coming out of the business account, or a little of both, or you're using a personal credit card for the business expenses. And what that does is it makes it more difficult for you to be able to organize the transactions because you're pulling from too many places. So part of this organizing is also creating streamline or processes that allow you to streamline the process. Having a business bank account, having a business credit card, and using that. If you are at a position where there are more expenses than what the business can sustain, it's best to transfer money from your personal to your business to account for those. That way you're able to find all of the business transactions a lot easier. It also allows the separation of personal and business, so that way you're able to protect yourself and your assets. So that's just one thing to consider with the bookkeeping. The next thing we want to consider is the due diligence process. So the bookkeeping, again, is your way of protecting the finances, protecting your assets, and also being able to monitor and navigate your business from the financial standpoint. So one, it's important to educate yourself, any management team that you may have, or stakeholders on funds earned and spent. So the best way to educate yourself is to have the bookkeeping done, or for you to do the bookkeeping. That way you're constantly aware of the performance of your business, and it helps you to pivot quicker. Then you want to ensure all funds received and spent are yours and reconciled to your records. As I mentioned before, there's many times when the transactions in your bank account don't match the actual transaction, or you may have been debited, there may see two debits for the same expense. So I'm sure, especially as we're more electronic, we see more and more where the banks make mistakes or there's system glitches. So in order for us to do our due diligence, we want to make sure that we're ensuring that all of the funds in our account belong to us and they are the right amounts. And then lastly, we want to provide a foundation for business decisions. So if you're looking at financing or you're considering going for financing, Having it done ahead of time and being able to have that internal assessment can make the process easier when you go to the bank and know what you're asking for and know what you can afford. Or if you know that you want to purchase a piece of equipment, knowing what resources do I currently have, and do I have enough to afford the equipment? Or even if you're leasing or financing, can you afford that payment over the next 5 to 7 years? Or is it going to cause a bottleneck? So when you're looking to answer these types of questions and you're looking to grow your business, invest in branding, whatever the case might be, it's easier to do when you have organized information to be able to look and see how much did you bring in and how much did you spend on the business, and looking not only at the cash flow, but also a financial statement. We then want to look into reflecting on the bookkeeping. So did your income and expenses for prior periods match your expectations? I know this is something that I do every month. And sometimes I don't like looking at my own financials because I already know the answer. Or sometimes I think I know the answer and then the truth hits me like just a ton of bricks where I'm like, oh, I did not do as good as I thought I did. So being able to take that time and look at that prior period helps me in becoming a better version of myself and better running my business. And this is a real life example. I looked at March and I was just torn to pieces at what I thought I brought in and spent, and it didn't match what I thought. So looking at the hard numbers made me realize that I need to bring it back and just reassess my spending for the next month. Like, okay, I didn't do as well as I thought I did, and it didn't meet my expectations. What can I do to make sure I prevent this situation in the future? And then looking at, are there areas where you can improve your spending? I looked and I spent a significant amount of funds on dues and subscriptions. So now my biggest priority is going back and seeing, do I really need all of these subscriptions? Because I've spent more than what I realized. But because I have these financial reports, I'm able to look and see that. And are there any questions or concerns so far? Okay. So being able to look, when you have the financials, you're able to see it from a monthly standpoint, quarterly or annually, and then looking at how those smaller amounts accumulate quickly. And then seeing, are you earning what you desire? So this was an exercise that I've done with a few people, including myself recently, when we were setting our goals for the year and saying, okay, I want to increase my revenue by 50%, or I want to increase by 25%, whatever the goal is. And then we start asking questions based off of prior year data. So for those that have bookkeeping records, we can then go back and look and say, okay, well, in this 12-month span, it looks like these were the slower months or the slower periods. Is it realistic for us to be able to double the spending in that period? And that could be a simple yes or no, but then the next question is how. So if we know that our goal is to increase our earnings, how can we do that if we know it's a slower month? Or one thing that I've done earlier this year, when I was looking at where I want to be and where I am, is if I'm working 6 or 7 days a week and the revenue isn't increasing, then I need to go and figure out why. So because I'm looking at the financials and I can compare this year versus last year, I'm busier, but my revenue isn't increasing. What that allowed me to do is, in reflecting on the comparison, I then looked at my calendar and started looking and saying, and trying to evaluate, am I busy with revenue producing activities, or am I busy just to be busy? And that led me down the road of recognizing that I was spending a lot of time doing things that wasn't earning me money. Where in my mind, oh, it's development, I'm creating relationships, which is great. But if it's not helping me towards my goals and it's not reflecting on my financial statements, then I need to pivot. That way I can be active throughout the year and not burn out mid-year. So having that reflection was really directed based off of the reporting from the bookkeeping system. And then looking at what's the difference between your forecast and actual expenses. So at some point, we'll speak about budgeting and forecasting. And then when doing so, we're going to learn how do we create forecasts and make them realistic. So we want to make those SMART goals and being realistic in our forecast and our budgeting. And that's just part of the process. So yes, we're going to create a budget that we can use for the next year, 2, 3, 4 years. But then after that, we want to then have the reflection of, okay, it's been month 1, month 2. Am I on track to meet that forecast that I made from the prior period? And if not, why? And is there something that I can do to pivot? So we create the budgets not to tuck away in the folder, but we're creating it because it's supposed to be an active document that we use throughout the period. So creating a forecast means in order for us to track our performance, we must track our bookkeeping to make that working document work for us. And then are there any questions regarding anything on the bookkeeping reflections? Or are there any challenges that anyone is having so far in relating to bookkeeping? So the next question that we're asking is, how can you use financials developed to plan for future endeavors? So I would like to ask if there's anyone that's willing to speak about what are some of their future plans with their business and how can you use those financials to help you with those?
Christina, could you repeat the question, please?
Sure. So the question was, what plans do you have for a current or future business? And then how can we use financials to help you plan for that future endeavor?
Does it matter that we don't have a business per se, or agro
No, it does
business?
not. No, it does not matter.
I can say, just like from prior years, you can get a picture of what the future is, but then if you want to grow, then you may want to look at expenses that may come along for the growth to project in your forecast.
Yeah. So I know like I have a personal goal that I want to increase my savings. Silly enough, during the same time that I'm trying to grow a business, right? Um, and I'm currently reworking. I use Mint to track my personal expenses. And Mint just hurts my feelings all the time because it shows all of my bad decisions. And I started today working on my budget because in order for me to save, I have to stop eating out, frankly. And that was a big part of my budget, is the convenience of eating out because I'm working so much. So I'm using the financials that are in Mint that's showing me what I'm bringing in and what I'm spending to say, okay, well, if I want to stop eating out, that means I have to cook more. And in doing so, it's tying into the other goal that I have of not just increasing savings, but balancing myself, because in order for me to cook more, I have to be home. So that's one thing that, I'm using for my own bookkeeping from a personal standpoint, is for me to reach my goal of saving more money. I have to be able to I'm looking at the financials to track what are my monthly habits. And I check it every day as if I don't know what I've done, because I need the daily reminder that, no, Christina, you need to go home and eat what's at home. No, don't stop for that cup of coffee. It's $4, but it's $4 extra dollars that I continue to spend versus making the 50-cent cup of coffee at home. Dottie wrote in the chat, you can use the financials to purchase inventory. So if she has a baking business, the financials could be used to help in determining that. And that is very important, is when you're purchasing raw materials and you have 10 different things that you have to buy to make that one final product, being able to know, one, can you afford it, and how much do you need of each in order to create the product. But then it gets more complicated if raw material 1, you need 3 bags of this for the product, and this raw material 2, you need 1 bag, and they run out at different times. So keeping those financials and knowing can help you with determining how much to purchase in inventory, how much you need for raw materials, but also, like, are your profit margins or gross margins where they need to be able to continue in business. So those are a few examples. Thank you, Donna, for participating. I appreciate it. And thank you, Dottie, for your contribution as well. So some good bookkeeping habits that we can consider in trying to improve our financial management systems. One, using different accounts for personal and business expenses. And then Donna. Oh, thank you. So using different accounts for personal and business expenses. So that's something that I had mentioned before, trying to separate as much as you can. When you have everything pulled together in one account, it's very hard to decipher what is personal and business. And it's also a lot easier to spend funds that really should be set aside for different purposes. From a liability standpoint, it is difficult to separate your business from personal affairs and to prove that if something was to go awry or if you ended up in any type of legal situation, if everything is commingled. So I am a big advocate for making sure a business account is for business purposes, a personal account is for personal purposes. And if you need to take a draw, you can take that from the business, or if the business needs to borrow money from you personally, you can transfer that as well. The other thing is recording revenue and expenses daily. There are software that can help in pulling the information into a centralized place to make that easy for you. So investing in QuickBooks, they have, QuickBooks Self-Employed, which is the lowest subscription level that they don't always promote very well on their website. There's HoneyBook. I know there's some other ones that I've heard of as well. Mint is one I use for personal, that's free. But there's just ways of being able to make sure that you're documenting it. And when you have that information centralized, it's easier to also validate and review your entries. So that's the next one. Carefully reviewing the entries, making sure everything that is leaving your bank account and everything coming in the bank account is yours, and that you're validating that information, and then you're categorizing it correctly. So tailor your bank statements to coincide with preferred accounting practices. There's times when there's inquiries about what accounts or categories should someone use. And there are standard ones that can be for the industry or for the tax returns, but it's every business's chart of accounts may look different as well. So you do have some flexibility in tailoring your chart of accounts, which are the accounts that you're using for categorizing your expenses and your revenue. And so you have this option of being able to tailor it to being able to reflect the information that you want. So I changed mine this past year because I wanted to be able to see, well, how much money am I earning from training? How much money am I earning from tax preparation versus tax planning? So you can do the same thing for your business. Like, so if you have a baking business and you're like, well, I want to know how much am I making from cakes versus how much I'm making from muffins. You're able to create the categories that best fits your use, and then your tax preparer or accountant can help in making sure that it's reported correctly for tax purposes. And then lastly, leave an audit trail. So we don't like the word audit, I'm aware, but it's best when we use a debit or credit card to purchase things. So I know for some industries, cash is still king, but cash is hard to track. And if you were to be audited, or if you have to validate your expenses or revenue for any reason, cash is very difficult to track. And our new version of receipts usually fade in 3 months. So using a faded receipt to validate an expense is not ideal, nor may it be counted. So just thinking of leaving an audit trail can be important, not just for the IRS or for the bank, but for yourself if you were if you ever needed to reference back. There are times when we reference back when we're like, I think I bought this. Let's say you had a piece of equipment break or a key kitchen accessory that you use and it broke and you don't remember where you purchased it from. If you paid for it with cash, how would you know? Versus if you use the debit card or credit card, it's easier to go back and look on your statement to find it. Or it's easier to go back and look if you bought it electronically or online, going to your email. So we just want to be careful that when we're having good bookkeeping habits and creating those habits, that we're being intentional about our financial management, not just from a spending standpoint, but also from a documentation standpoint. So mistakes that we want to avoid: throwing away receipts. So even though they fade in 3 months, not all of them do, but a lot of them do. Maybe keep an envelope or a folder in your vehicle, at your desk. I keep a folder in my my laptop bag, and it's like a random dump folder. And when I have my receipts, I put them in there. And then about once a week, when I'm cleaning out that bag, I have the folder and I can separate out the receipts and file them accordingly. That way I'm able to keep the proof of documentation, but also it helps me in maintaining strong financial practices. Consider, one other mistake that we want to consider avoiding is doing your own taxes or managing your own books. I am a proponent of, if you're starting and cash is tight, I understand you may do it yourself, but at some point, it is important to have a professional or someone with a strong background assist you in that. So we don't want to over-report our income if we don't want to over-report or under-report our income. But we also want to make sure that we truly have some strong financial practices. If you can't afford to have a personal accountant, the Small Business Development Center is a great resource as well that is free for you, that may be able to assist you with like an annual review just to make sure everything looks good. We want to avoid neglecting tracking reimbursable expenses. So if you have the home office, it's things that we spoke about in the tax workshop a couple of weeks ago, but let's say you have a dedicated home office. Is that something that you're documenting and making sure that you're claiming the deduction on your taxes? If you are the business owner and you are using personal funds to purchase things, are you allowing the business to reimburse you? Even though it is your business, that we want to keep the concept that the business is a separate entity from you as an individual. And as such, that means when you purchase things, you should be reimbursed from that entity, even if it's in a couple years. But we want to be able to document what does the business owe you, and that way when it can afford to reimburse you for that, you're able to get your money back from the business without it being taxable. So that's another thing that we want to consider avoiding, is not tracking those reimbursable expenses or tracking your investments in the business. We want to avoid the failing to reconcile books against bank statements on a regular basis. As I mentioned, the banks are not always correct. They do make mistakes, and software also makes mistakes. And there are times you can't, if you see something and you're like, wait a minute, I've been billed this erroneous expense for the last 6 months. Many banks will not reimburse you for 6 months. They might give you the last one. But as a business, you have a shorter time frame to report a discrepancy on with your bank account than as a person. And even as a person, it may be a week. So don't quote me on the exact time frames, but I do know that it's a very short period. And so it's most important that you reconcile and that you review your accounts to ensure that everything that's yours is actually reflected on your statement and you're not taking credit for someone else's transactions. We want to avoid forgetting to deduct sales tax. So sales tax is deductible. If you itemize as a person, you can deduct, itemize it, but also as a business. And if you are a business that has a sales tax certificate, a resale certificate, making sure you use that bad boy and try to take advantage of all of the benefits of being a business owner. And then also we want to avoid miscategorizing or over-categorizing. So I've had a unique experience with one entity where they were overly detailed. And as great as it is, and I know that we want to have all of the information, part of the issue was they were pouring so many resources into this one task that other areas of their organization were not operating efficiently. So we want to find a system that best works for the information that you want reflected, but we also don't want to overcommit to the time frame, the time that it's going to take you in doing so, because I do understand as an individual, a human, as a business owner, there's so many things that we need to do. And this is just another thing added to the list. But because it is critical in our society to make sure that we are aware of our finances, we just want to make sure we find a great balance that can help us in taking the time to organize the information and complete our due diligence, and also making sure it's reliable for us to use without it being a burden on top of everything else that we have going on. So before I talk about the financial statements, I just want to pause and make sure there aren't any questions, comments, or concerns from anyone. Okay. So our first financial statement that we're going to talk about tonight is the balance sheet. So the balance sheet is really, I got your comment, Dottie, so we'll definitely talk about that. The first report is the balance sheet. So this is really going to tell you the larger scope of the business. So it's what you own versus what you owe, and then the value, one way of measuring the value of the business. So the liabilities, the plus the equity, which is this section, equals the assets, or the assets equals liabilities plus equity. So it's going to help track at any point in the business, what you own and what you owe. And it's going to help in determining the financial health for the business. So when we think of assets, that's everything the business owns. So your current assets are things that are most liquid. So when we say liquid, it means what can be converted to cash the quickest. So we know cash can be turned to cash quickly because it's already there. Accounts receivable typically is one that is very liquid, because the idea is that the receivables is money that someone owes you, a customer owes you, but you generally can anticipate that within a set time frame, whether it's 7 days, 30 days, or 3 months. And then inventory is considered a liquid asset as well, because it's something that you would be selling in the near future. Our fixed assets, that's going to be our investment in the business that's going to help us in generating revenue. So that could be our major equipment and machinery. It's our land, our building, any types of improvements we made to the building for the space that we would be using for the business. And then our liability section is what we owe. So accounts payable are considered bills that we paid within a year, really within 30 days or so. So that's like when the city sends you or the city or county sends you your utility bill, and you're going to pay that within 20 days because they tell you have to, right? That would be an accounts payable at the time that you receive it, because it's money that you owe someone, but you may not necessarily pay it right away. Then we have taxes payable. Similarly, let's say it's sales tax, use tax, income tax, where at some point you derive at the amount that's owed, but you may not pay for it right away because you're given a grace period to submit that payment. And then long-term bonds issued, if you were one that was that's more so for larger corporations that are issuing bonds that they know that they'll have to pay to receive back. Our equity is really our investment in the business. So common stock is like the purchase of stock in the business. That's primarily for like S corporations and C corporations. And then our retained earnings, which is the accumulation of net incomes for the life of the business. So theoretically, a positive retained earnings mean your net earnings over that period of the life of the business is positive. So that's going to help in increasing the equity, thus increasing the value of the business. If it was negative, it typically means that you've had more losses than net income or positive net incomes for the life of the business. This one is one of the primary financial statements that banks will use when you're requesting a loan, because this is going to help them determine the financial health of the business. They're looking to see, and if we look at this specific example here, we see that we have $70,000 in current assets and $88,000 in fixed assets, and the liabilities are $40,000. So a bank may look at this and say, okay, well, they have $88,000, between total current assets and fixed assets, there's 88,000, but they only owe 40,000 in asset or in liabilities, my apologies. So the bank is going to say, well, we know that this entity technically with 70,000 in current assets, they could pay off their liabilities. So a bank may be willing to lend more money because it can see that this business is in a position to afford the debt. That may not always be the case. And if you're a single member LLC, you may have experience where a bank has asked for a personal finance statement, which is similarly a balance sheet for an individual. They're asking, what is everything that you own? How much is in your bank account? Do you have jewelry, auto, a home? And then on the other end, it asks, well, what credit card debt do you have? What mortgages you have? So it's looking to see, can your assets sustain your liabilities? The bank is also going to look at the equity, because if this was negative, that's indicative that, okay, this is a business that's continuously losing money. Is this one that we want to lend to, especially if you don't have the assets? So they're using this to help determine the financial health and determine their level of risk if they want to lend and at what amount. So Dottie put in the chat that she wanted to discuss more about tax certificates. So Dottie, are you referring to the sales tax certificate that I mentioned before? Okay, so the sales tax certificate is typically for businesses that submit sales tax. So when you open a sales tax account with the state, so we're in the state of Florida, so I'll use that as an example here. The Florida Department of Revenue, you can go and apply for a sales tax certificate or a sales tax account. With that, you are required to report all of your sales and then your taxable sales back to DOR. But it also allows you to have this sales tax, a resale certificate. This certificate is stating that you are a business that will be purchasing materials or supplies that will be sold, that you're purchasing for the purpose of selling it again. So with that, you may be able to bypass paying sales tax for certain things because you're going to sell and collect sales tax and submit that back to the Department of Revenue. Does that answer your question, Dottie? Okay, perfect. So the second most commonly asked for document and the most commonly used document is an income statement or a profit and loss statement. So this one is the simplest to compile, and it's really going to reflect your income minus your expenses. So the idea here is that you're going to collect all of the different income sources that you have, whether it's direct sales at a farmer's market, if it's sale of crop, whether it's wholesale or direct to consumer, if you're selling livestock products, if you have grant income, which most grants are taxable. So looking at all of the different forms of revenue that you have. And as you can see here, I mentioned before that you can determine what categories you want to use that best reflects how you want to analyze your data. So as long as we report this bottom line of the 85,000, the subcategories, you do have flexibility with the subcategories. So there's room for you to be able to customize based off of what you're offering and how you want that information to be best reflected. So some folks are like, I just want it to say sales. I don't necessarily care. Others are like, no, I really want to be able to track year to year. How much am I selling of flowers versus how much am I selling of kale versus how much I'm selling of X, Y, and Z. I will say, speaking specific to income, it can be at times easier to track if you're using a point of sale system, because you can set up the items with the prices in the POS system, and that will help track it for you. So there is some work that can be done through software, so that way you're not manually doing all of the work. So I just want to keep that in mind when you're thinking about how you want to report the information for yourself, and also streamline the amount of effort and work that's involved. On the expense side, similarly, there are some standard expense categories that you'll find on the tax return, like seed, fertilizer, depreciation, and there's still some that you might want to break down further or add categories that may be specific just to you or your business. So with that being said, the idea here is for it to be beneficial to you as well. So when you're thinking about the different expense categories that you want to use, think about what does it take for you to operate your business, not just the direct costs, but also the indirect costs as well. So the income statement is meant to show the performance of the business for a given period of time. So this income statement may only be for a full year, or it could be for a month or a quarter. So unlike the balance sheet, which is for the life of a business as of a certain date, that this statement, the income statement, is only for a given period of time to show the performance of the business. So in this table, we can see that there's a total income of $85,000, and then we have total expenses of $70,000. So there's a net income of $15,000. So it's great. This business made money, and the income statement at the end of the year or the end of the fiscal period rolls into the balance sheet. So all of this information here combines into this net income of the $15,000. This number of the net income rolls into retained earnings. So as I mentioned before, retained earnings is the accumulation of net incomes for the life of the business. So this net income will then, at the subsequent period, be rolled into that retained earnings and will help increase equity, thus increasing the value of the business. So that's another important reason that we want to keep the bookkeeping, because as we're going through, as we're creating our business, as we're continuing and strengthening our business, these financial statements are going to help you in being able to accurately represent and communicate the value in all of your efforts of the business. And when you need financing, that equity piece is going to be extremely beneficial to you. So although we know that we want to expand our viewpoint and change our perspective of bookkeeping, the financial statements is really what drives our ability to borrow money, and it drives our ability to be able to find investors or really evaluate the performance as an entrepreneur. So you are your biggest investor in your business, and thus you should give yourself the greatest respect to make sure that you're able to evaluate the performance. So I am now going to ask for any final comments, questions, or concerns. As I mentioned before, when it comes to accounting and financial topics, I'm a big proponent of keeping it short and sweet, as it's a lot of information and it builds upon each other. And as we go on throughout the year, you'll see the strong relationship between accounting, bookkeeping, finance, banking. All of these concepts together are interwoven. So we want to take our time in the journey of learning more about it, but I also wanted to give enough time for anyone that may have any questions or specific challenges that they wanted to discuss. So are there any final questions, comments, or concerns?
You did a great job keeping it simple, Christina. Thank you.
No problem. That is why I'm here. I will say, as the final plug, if you are not on the email list, you should be. We have so much going on in the next few weeks. So in addition to the classes that I'll be hosting for accounting finance, beginning next week, we have a 3-part series on Wednesdays that will be on Facebook Live, focusing on marketing and advertising. So that will be by Brian Sornay with Alcom Marketing or Capstan Marketing. We also have our Serve Safe classes coming up in May, June, and July. So there'll be one in Gadsden County Extension Office, one at Leon County's Extension Office, and Jefferson County. And those Serve Safe Manager certification courses are free. So if you are a business seeking that certification, please reach out to Audrey. Her email is here, and that way she can send you the information to sign up. It's a 2-day class, but we're also going to have study sessions 4 weeks prior to each one. The trainer highly advises to study beforehand. We also have a social media management class coming at the end of the month. And then we will be preparing for some value added classes in June, talking about like the greatest hurdles, the rules and regulations. So we have our kitchen manager that is beginning the workshops in June before we start getting into some more nitty-gritty details. So there's a lot going on. Everything is free, so please spread the word. But also, if you have any comments, questions, concerns, reach out to Audrey, and I can also be of assistance. Business development consulting, marketing consulting, and accounting consulting are part of the program. So it is free to you, and it's free to anyone that is interested. So please, I am gracefully asking those that need assistance to please reach out so we can help you as much as we can. And with that, if there are no other questions, have a lovely evening.
Thank you, you too.
Thank you. You too, Christina.